Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Easynomics. Easynomics at a time when the Reserve Bank of India has just now announced an out-of-policy cycle 40 basis points hike in the repo rate and a 50 basis points hike in the CRR. Aggressive rate hike and a measure to suck out liquidity at a time when RBI Governor Shaktikanta made it clear that inflation is the biggest worry as far as the Indian economy is concerned. The month of April seeing significant hikes in food price inflation, and the RBI Governor saying that that is likely to continue. In summary, really, this rate hike and the CRR hike in some ways reverses what was done 2 years back, almost to the month and date in May of 2020, which was the second rate cut at that stage of 40 basis points that was announced at the peak of the COVID-induced lockdown. Remember, the first rate cut of 25 basis points had come days after the lockdown on the 27th of March 2020. It was followed by another cut of 40 basis points on the 22nd of May. And today, the RBI governor pointing to the fact that this is now a reversal of that last cut and also a CRR hike. Markets reacting, the Indian stock market cracking, deep cut. Obviously, bond yields reacted to this out of policy cycle cut. And what the RBI governor said, and if we read between the lines, it is very clear that the RBI could undertake further actions as may be required. And before I tell you why, let's once for a moment remain clear on another aspect of what the RBI said. The RBI has also said simultaneously, while hiking the rate and the CRR, which is the reserves that banks have to maintain as a statute, what he has also said, the governor, is that the policy stance remains accommodative given the concerns around growth. So this is a balancing act in some ways between the inflation and growth dynamic that India is faced with. In both cases, the current round of inflation primarily being supply side inflation, yet since that inflation has seeped into food prices, it becomes a very significant policy concern. And that policy concern has come through in what the RBI governor has said, because the other side of the argument was that if it is supply side inflation, then how does tighter monetary policy help in combating inflation? So the RBI governor making it clear that the priority remains to combat inflation at this stage, although the jury will be out as to what would happen if petrol and diesel prices start rising or get changed every day. Remember, after almost 10 or 11 successive hikes of 80 paisa each, we have seen the clock stop, and the clock stopped as far as petrol and diesel prices is concerned almost a month ago. And that decision, while it may have had an immediate salutary impact on the price situation, comes at a time when crude oil remains elevated above $100. So there is no major softening of crude oil. The pass-through of crude oil price adjustments on a daily basis that had been stopped and started and now have been stopped again is the biggest question that we could raise at this stage. If the oil companies are allowed to respond to price fluctuations in crude and that gets passed on, what will be the impact of the RBI moves? And that is why one should remain prepared for another reversal to go back to a pre-March 27, 2020 situation, which was when the first hike of 75 basis points had happened. So 75 plus 40, of that 40 being reversed, the other 75 remaining, and a significant hike in CRR. Again, CRR had also been altered. So we are now reaching a stage where monetary policy seems to be aligning successively and perhaps through further actions 4 to 6 weeks, 8 weeks down the line with a pre-COVID monetary policy era. So a headline very clearly, as the Indian economy moves back to a pre-COVID era in terms of capacity utilization, in terms of economic growth, in terms of normalization of jobs, in terms of normalization of trade, transport, and other aspects of economic activity, monetary policy is also now reaching a pre-COVID situation. And that clearly tells us that from an overall standpoint, we are now in a situation where interest rates are likely to harden further. The RBI governor also making that very important point about what is happening globally when it comes to the interest rate cycle. The global interest rate cycle has also turned, and that turn was hastened by Russia's invasion of Ukraine and subsequent developments which had been building up, including unprecedented rise in US inflation, an economy which had managed to keep inflation low for decades together. That inflation spurt happening on account of the loose monetary policy, plus the huge infusion that was given through government handouts and government cash in the hands of US citizens through the program post-COVID, and that feeding into US inflation, even though US job growth remains strong. So the global interest rate cycle seems to be turning. Europe clearly reacting to what is happening in Russia and the consequences of the invasion. Fuel prices are worry all over. So how could India remain decoupled from this situation? And finally, if you are a borrower, either existing borrower or a new borrower of a retail loan, particularly home loans, you are now set for a situation where home loan rates are likely to rise, and perhaps even if they remain at current levels, there is no hope of a cheaper home loan. And this comes at a time when the real estate cycle has also turned, especially for mid and upper premium category luxury homes. The affordable housing segment still in the doldrums as far as the impact of the economic slowdown and the COVID-induced slowdown in economic activity is concerned. But coupled with pretty healthy home loan sales and an interest rate cycle which is now turning the other way, we'll have to see how the real estate sector responds. But very clearly, the markets in India reacting. This was expected, yet the timing of the announcement, the manner of the announcement, obviously coming as a bit of a surprise. The markets had been a little nervous and skittish. And as I wind down, the latest numbers at 2:38 p.m. this Wednesday afternoon, after the RBI's out of policy announcement, the Sensex down close to 2%, down 1,152 points. The Nifty 50 down over 2%. The Nifty Bank also taking a hit, down 1.72%. The Nifty Mid Cap, it's sea of red. There are 1,567 declines versus 357 advances. Just a few stocks holding up: Rain Industries, ONGC, Britannia, Petronet, LNG, and many of these stocks responding. Shriram Transport, rate sensitive stock, down well over 7.3%. Alembic Pharma down, Info Edge down, Apollo Hospital down. Some of the big boys there also falling: Reliance, HDFC Bank, Tata Steel, consumable like Britannia holding up, BHEL holding up. So overall, as you see, it's very clear that the markets have taken a hit on account of this fall. Will calm be restored in the markets? Well, as the markets absorb and discount this, the commentary on inflation by the RBI governor will be one of the significant worries, because markets remember and have deep memories about how inflation has remained sticky. And I'm reminded of the 2013 phase of higher consumer price inflation and subsequent actions, both at the monetary fiscal level. This time, the levers of policy available with the fiscal and administrative authority, including actions to change tariffs when it comes to edible oil or moves on wheat exports. Remember that we've been increasing our wheat exports, plus with monetary policy. The key difference this time is that the Indian economy has emerged out of, or is still emerging out of, 2 years of a COVID-induced slowdown. So we'll have to see how this plays out and how the impact of this move remains. For now, that's all that we have on this episode of Easynomics. We'll keep coming back with more. Till then, please do like, share, and subscribe Business Today. Good afternoon and goodbye.